Once again, investors' thirst for yield may be leading them astray. I'm Jack Otter, editor of Barron's.com. I'm here with Mike Aniro, who writes our income investing blog. So, Mike, this week in the magazine, you tackled the topic of leveraged loans. Before viewers fall asleep, let's explain they have great yields, 4.5%, 5%.
About that.
But you point out some danger signs. First, what is a leveraged loan?
Leveraged loan, in short, is a bank loan made to a company with junk credit ratings.
Now, how is it different from a good old junk bond, which is also very popular right now?
The main differences for investors, number one, leveraged loan rates float, where junk bond rates tend to be fixed. And the second most important thing is that leveraged loans, in the event of a bankruptcy, get paid back before junk bonds. So leveraged loans tend to pay a little bit less than junk bonds because there's a little bit less risk associated.
Relatively high yield. They'll go up when interest rates go up, but what's not to love?
Well, the key point that I try to make in this column this week is that when people think of rising rates, and many people are afraid that rates will rise, they tend to think first thing of Treasury yields. And leveraged loans are not based on Treasury yields. They're based on a short-term lending benchmark known as LIBOR. And second, there's a provision in most leveraged loans that have been issued since the financial crisis called a LIBOR floor. And it means that no matter what LIBOR is, you're going to get paid a minimum. And that minimum is currently about 1 percentage point. Actual LIBOR is about 1/4 percentage point. So the net for investors is that short-term rate will have to rise about 3/4 point before these loan rates start to float at all. And that's not expected to happen probably for another year.
And so you do have an alternative that you think is a little bit more attractive right now. Can you explain what that is?
In the column, I looked at some other types of floating rate investments and talked particularly to one fund called the Leader Total Return Fund that has found some other floating rate investments that tend to be bank issued floating rate bonds that are tied to either Treasury rates or other government bond rates that investors might have a better handle on.
So they might go up a little sooner if rates rise.
Exactly.
We should point out, of course, that the entire investing thesis here is everyone's complete confidence that rates are going to go up tomorrow, that inflation is just around the corner. Of course, inflation, there are a few hints of it, but it's not really here. Rates have not been going up. So anyone going into this needs to at least question that assumption. Nothing wrong with these investments, but question the assumption, that surety that rates are going to go up.
Right, and if you look at what's happened through the first quarter or so of this year, people thought that rates were going to continue to go up. They haven't gone up yet.
In fact, they went down.
Right, and the long-term thesis is that rates will rise eventually. The question is when.
We're still waiting for eventually. Thanks, Mike.